Hello, everybody. My name is Olivia Lozano, and today I'm coming by with some important advice about credit cards. Credit cards can be a very great investment financially. Having credit can be an incredible financial cushion to have, but it's important to know how to use it so you don't end up with massive debt. So just to begin, what are credit cards? Credit card, you've probably seen it, is a plastic or metal card electronically connected to funds which you can borrow from a creditor. And a creditor is a person or a company which you can borrow money from for various purchases. Think things like MasterCard, Visa, Capital One, etc. Now, whenever you see credit card commercials, you may have heard some of the following terms. APR. And that stands for annual percentage rate. It's the interest you pay on the money that you borrow. And this is part of the way credit card companies make money. When I was a kid, I didn't understand how credit cards worked. I was like, well, if they're giving out so much money, then how are they making money? How are they still in business? This is how, through things like APR and other fees. Another important term is the grace period. It's the amount of time between when you pay back your creditor and the end of the billing period. You can pay it off before the due date, but you should only do it if there are no prepayment penalties. When you do that, they can charge you a pretty decent fee for paying off early, and some credit card companies do this to kind of keep you from getting ahead, which is part of the reason why it's important to look at the terms and conditions before applying for a credit card. And but if they do let you do that and your amount is paid in full, you cannot be charged for the interest, and the grace period will actually be extended. A grace period, I believe, is 21 days. So you have 21 days in between the time the grace period begins and the time you have to pay off your credit card. Okay, now we're going to talk about credit and loans. First thing you know is revolving credit, and in this one, money is borrowed with a limit, and you can pay it in full or a minimum, and you can pay it in full, or you can pay a minimum and it gets carried over into the next month. This is called a revolving, hence why it's called revolving credit. Next type is installment credits, and that's a specific amount of money that is repaid over time with interest and installments. You know, you may have heard banks doing stuff like this. When they give out a loan, you pay it back with interest. You pay it back with the amount they gave you in installments with like a little more each time so that the bank can make money. The next one is a secured credit, and that's a card with a refundable deposit, and it works like a traditional credit card. And this is for people, you know, whose credit may not be so great. It's got a limit on it, and they have to pay a deposit on it. So, you know, in case things go wrong again, they can have their money. But it is refundable, so that is good. But other than that, it works like a traditional credit card. And then there's unsecured credit, and this gives the lender no ability to regain payments in the event of a delinquent borrower. These are very risky, and I think there are a lot of creditors who really don't like to do these because of these sort of, you know, limitations. So you have to have a very good credit score or very good credit report in order to apply for one of these, which we'll talk about a little bit later. Now we're going to talk about types of loans. You may have also heard some of these terms. Mortgage, and that's a loan given to help buy a home, and this usually lasts about 15 to 30 years, depending on what plan that you buy or, you know, pursue. Then there's auto loans, and those are given to help purchase a car, and those last, you know, 3 to 5 years. And then student loans, that's the big one. They're used to help students pay for their higher education, and these usually last about 10 years. Unfortunately, there are a lot of cases nowadays where people cannot pay off their student debt, and the debt just piles and piles and piles. Okay, credit reports. How to read them and why they're important. So, like I said before, if you want to get unsecured credit, which is really risky, you have to have a good, I mentioned stuff about a credit report. And that's a report of all your credit activities that is either mailed to you or you can access it electronically. Now, these include personal information like address, social security number, and have things like the number of loans, mortgages, accounts, payment history, inquiries, and any lawsuits over debt or bankruptcies. And it's good to check this thing every 4 months just to make sure, you know, you're not being charged or something that you did not do is going on your credit report. You don't want that to happen, especially if it's something bad. And you can improve this credit report by using less than 30% of your credit limit, and of course, pay your credit cards off on time, and by just, like I said, going through, making sure you don't have any errors on your credit report. It's also very important that your credit report looks good so that any potential investors might look at your credit report, see that you have like little to no bankruptcies. Then you're good. They see you're a responsible lender or borrower, pardon me. Now we're going to talk about credit score. And it's a score that determines how worthy you are of certain loans or credit. You'll also find this on your credit report as well. And it's composed of the following 5 aspects: capacity, and that's the percentage of the credit limit available. The accumulation of debt, that's the number of inquiries that you have acquired in the past 12 to 18 months. The types of credit, all the various types of credit that you have. So using installment credit will raise your credit score, but revolving will lower your credit score, especially if you're not paying it in full. And there's the payment history, and that's, you know, whether the bill was paid late or on time. And then there's the length of the loan. So basically how long the loan's been open. And like I said, a good credit score along with a good credit report can show banks and other lenders that you're a responsible borrower. And this is good for big purchases like, you know, homes and cars. Maybe you want to build a house or something like that. If you show the bank a good credit score and a good credit report, they might go, hey, this person looks like looks very financially responsible. So I think this will be a good investment for me. Okay, now we're going to talk about every credit card holder's worst nightmare: late payments. And these lower your credit score, which, as you can imagine, that makes a lender less likely to give you favorable interest rates and loans. Heck, they might even turn you down. You get charged late fees, and this may raise your interest rates on your bills. Frequent late payments may actually lead you into debt. So when late fees, the high interest rates, and the inability to pay in full will kind of snowball into this massive gap between your ability to pay for things and the debt and the amount of debt. And it gets wider and wider and wider and wider. And unfortunately, this is a situation too many people have ended up in. And that's part of the reason why it's important that we do educate people on credit and how it can be useful, but at the same time, some of its pitfalls and the ways it can be dangerous. So, taking all this into perspective, what exactly have we learned today? Well, I think the first and most important thing is to always pay your credit card bills on time. This prevents late fees and the heightening of interest rates. You always pay it in full. This extends the grace period and improves the credit score. But remember, always only prepay on your grace period if they allow you to pay before the due date, because then they'll give you prepayment fees, and that's not good. This one is just kind of a general rule: never borrow more than you can pay back. This will put you in serious debt. And as always, just as a general rule, another one: compare offers of various credit card companies, and use higher down payments on credit to reduce the price of the installations of payments that you'll be putting in later. And here's just a list of some of the sources that I used. Okay, well, I hope you enjoyed this little presentation. Hopefully you learned something about credit cards today. Remember, always pay your credit card bills on time. Try to pay them in full if you can. Try to have a good, always remember to check your credit report, credit score very often. And if you want to take an investment, take a chance, people will be more likely to take a chance on you. All right, I hope you've enjoyed this presentation and have a good day.